Let me start with a statement that sounds almost offensive if you've spent your whole life doing things the responsible way. For many business owners and real estate investors, depreciation is the difference between feeling like the tax code is punishing success and realizing the tax code was actually written to reward the exact behaviors that create jobs and build communities. And yes, I know how that sounds, literally, because every spring I talk to high-income professionals and successful owners who say, Andrew, I'm paying more in taxes than I paid for my first house. And they're not exaggerating. They're doing everything right, working hard, building wealth, providing for family, giving generously. And then the IRS takes a bite that feels disproportional. So here's the bold, counterintuitive idea for today. Depreciation is not a loophole. It's not a trick. It's not rich people magic. Depreciation is a policy choice. Congress literally designed it to encourage investment. If you deploy capital into productive assets, equipment, technology, buildings, improvements, the tax code is built to let you recover those costs and keep more cash in motion. And right now, this topic matters even more because the One Big Beautiful Bill Act was signed into law in July 2025 and made major business provisions more permanent, including a permanent return of 100% bonus depreciation for eligible property acquired after January 19, 2025. The Treasury and IRS just issued guidance on how that works in the real world. If you own a business or you own real estate, that is not background noise. That is a strategic window. But here's the tension. A lot of people hear 100% bonus depreciation and their brain goes straight to, how do I buy something so I can write it off? That mindset creates bad purchases, bad timing, and sometimes bad exits. Our goal today is different. Today, I want to make you the person who can explain depreciation at a dinner table in plain English. And more importantly, the person who can use it intelligently inside of a long-term plan. By the end, you'll understand what depreciation is, why it exists, why it improves cash flow, what the biggest mistakes are, and how to think about depreciation in a way that supports your business plan, your real estate strategy, and your long-term financial freedom. Okay, let's explain. Let's define depreciation in plain language. Depreciation is the tax code's method of cost recovery. The IRS says that certain assets wear out, which they do, or become obsolete over time. So instead of deducting the full cost in 1 year, you recover that cost over a prescribed schedule. Here's the part that trips up intelligent people. Depreciation has almost nothing to do with market value. You can own an asset, especially real estate, that's going up in value every year and still take depreciation every year. Depreciation is not the IRS agreeing your building is worth less. Depreciation is the IRS agreeing you should recover your original investment over time. For real estate, there are standard schedules. Residential rental property is generally depreciated over 27.5 years, and non-residential commercial property is generally depreciated over 39 years. That's not a rule of thumb. That is a core framework the IRS teaches in its own publications. For equipment and many business assets, the schedules are shorter. Think 5-year, 7-year, sometimes 15-year property, depending on what you buy and how it's used. Now, here's why depreciation can feel like a superpower for business owners and investors. Depreciation can reduce taxable income without reducing cash flow. In other words, you might have real cash coming in, rent checks, revenue, distributions, but depreciation lowers the taxable portion of that income. That means you keep more cash inside the business or inside the household. That is the first big aha moment that matters. And this is why wealthy households seem to play a different game. It's not because they have secret accounts. It's because they own assets the tax code is built to incentivize. Now, when people start reading about depreciation, they often get overwhelmed by code sections and acronyms. You might hear people throw around 179, 168K, or 174. And just to clear up a common confusion, not every code section people mention is a true depreciation rule. For example, Section 170 is generally associated with charitable contributions. The depreciation levers most business owners talk about are Section 179, Section 168K, and Section 174, and it's its own category that affects research and experimental costs. Let's talk about those briefly in human terms. Section 179 is essentially a choice to expense certain qualifying property faster, sometimes immediately, rather than depreciating it slowly. It can be incredibly useful when a business has high income and wants to accelerate deductions, but it has limitations and phase-outs. Section 168K is bonus depreciation. Traditionally, this allowed you to take an additional 5-year deduction for qualifying property. It had been phasing down under prior law, but the 2025 legislation made 100% depreciation permanent again for eligible property acquired after January the 19th, 2025. And the IRS issued guidance to help taxpayers apply those rules correctly. Now, Section 174 has been one of the most debated provisions for business owners over the past few years. It changed how many research and experimental costs are treated. Instead of immediate expensing, there were capitalization and amortization requirements. Recent changes under the 2025 law moved domestic R&E back toward expensing and created procedural complexity that serious business owners should not ignore. You'll hear tax pros argue about this because it affects innovation, hiring, and cash flow. Here's the headline: depreciation is not a one-size-fits-all button you push. It is a timing system, and timing is everything. Let me illustrate this with 2 stories. One business owner example and one real estate example, because this is where people finally get it. First, a business owner. Imagine a successful small business doing $2 million in revenue and throwing off a strong profit. The owner decides to buy $300,000 of equipment, call it vehicles, machinery, technology, something that legitimately improves capacity and efficiency. If they do nothing special, that equipment is depreciated on a schedule. They get deductions over time. That's still helpful, but it may not match the year they need relief the most. If they plan intentionally, they may be able to accelerate deductions using Section 179 and bonus depreciation. That can reduce taxable income sharply in the year of purchase, which keeps cash inside the business at the exact moment the business is scaling. Now, this is where I'm going to say something that is both true and unpopular. A depreciation deduction does not make a bad purchase a good purchase. Some people go shopping for deductions. They buy things they don't need because someone told them it's a write-off. That is not a strategy. That is consumerism wearing a tax costume. Depreciation planning starts with business purpose first, then tax optimization second. Now, the real estate story. A real estate investor buys a property, improves it, and rents it. On paper, the rent looks like income. In real life, the investor has expenses, interest, taxes, insurance, maintenance, and then depreciation shows up as a non-cash deduction that can materially reduce taxable income. This is where the real estate conversation gets exciting, especially with the current law. Because with cost segregation and bonus depreciation, certain components of a property, personal property, and certain land improvements can potentially be depreciated much faster than the building itself. And if bonus depreciation is available, that acceleration can be significant in year 1. Now, I want to acknowledge the debate part of this because it builds credibility. When the new law reinstated 100% bonus depreciation retroactively back to January 19th, 2025, critics argued it was a windfall that rewards investments already made rather than creating new ones. There were estimates reported about how much corporations could claim and what it could cost over time. Others argued that allowing immediate cost recovery more accurately reflects how business investments work and supports productivity. You can disagree on the politics. That's fine. But here's the practical point for you as a business owner or an investor. The rule exists. That's simple. It affects your planning, and the people who understand the rule and coordinate it are going to have more flexibility than the people who ignore it. Now, let's connect this to the part that almost nobody talks about on YouTube: depreciation recapture. Because depreciation is powerful, but it is not free. Depreciation reduces your adjusted basis in an asset. Your basis is essentially your tax starting point, what you paid, adjusted for improvements and adjustments. When you take depreciation deductions, your basis goes down. So when you sell the asset, your gain is often larger than people expect because the IRS compares your sell price to your adjusted basis, not your original purchase price. And this is where recapture comes in. The government's logic is basically this. We allowed you to reduce taxable income using depreciation. If you sell the asset and the economics were strong, we want to recapture some of that benefit. For real estate, this commonly shows up as unrecaptured Section 1250 gain, which can be taxed at a maximum 25% rate on the portion of the gain attributed to depreciation, with the rest of the gain potentially taxed at long-term capital gain rates, depending on your situation. For business assets and certain types of personal property, what tax professionals call Section 1245 property, depreciation on recapture can be taxed as ordinary income, which can be meaningful for higher income earners. So, the question you have to ask, or should be asking, is not just can I take depreciation? The better question is, if I take depreciation, what is my exit plan? And what does the IRS bill look like when I sell? That leads to the second question. How long should I hold an asset if I'm going to depreciate it? There is no universal holding period, but there is a principle. The more your plan relies on depreciation to improve cash flow now, the more important it becomes to model what happens later. For many real estate investors, the strategy may involve holding long enough to refinance, reposition, or exchange. For some business owners, it means coordinating equipment purchases with long-term operations, not just year-end tax panic, which is typically the strategy. If you depreciate aggressively and then sell quickly, the recapture can be painful. If you depreciate intelligently and your plan includes longer-term holding, refinancing, or other exit strategies, the tax impact can be managed. This is why we keep coming back to the same thing. Depreciation is not a tax topic. Depreciation is a planning topic. So how do you apply this in real life if you're a small business owner or a real estate investor who wants to do this the right way? Start with 3 decisions in this order. First, clarify your intent. Are you buying this asset to grow cash flow, to grow equity, to create tax efficiency, or all 3? If you can't answer that, you are not planning. You are reacting. Second, coordinate timing. Depreciation is timing. Your income is timing. Your deductions are timing. Your exit, it's timing. You do not want your tax strategy to be accidental. You want it to be engineered. Third, plan for the full life cycle. That means asking, what happens when I sell? What happens if the year goes sideways? What happens if rates change? What happens if I want to retire earlier? What happens if I want to pass this on to my kids? When you do those 3 things, depreciation becomes a lever. It becomes a tool you pull intentionally, not a line item you hope your CPA handles. Now, let me give you a teaser for where we're going next, because in the next video, we're going to get much more specific, and it's where a lot of wealth is created or it's lost. In the next episode, we're going to talk about depreciation for real estate investors, what most investors get wrong, how cost segregation actually works in practice, how bonus depreciation interacts with that, and how to think about holding strategy, refinancing, and recapture in a way that protects long-term wealth. We'll talk about the exact question investors ask me all the time. If depreciation is so powerful, why doesn't everyone do it? And the answer is simple. They don't do it because it's not just a tax move. It's a coordinated move. It has to fit your income, your risk tolerance, your financing, your exit plan, and your long-term goals. That's why the best outcomes don't come from tactics. They come from a system. If this video helped you, share it with a business owner or investor who's tired of being surprised by taxes. And if you're the type of person who wants clarity, coordination, and a plan that actually connects taxes, cash flow, and long-term wealth, that's exactly what we do. I'm Andrew Nida with Asset Management Group. Thanks for watching.